All right, awesome. So let's go ahead and start. I wanted to talk to you about the usual questions that any client has, whether they're starting to actually purchase for the first time or they're going to go ahead and they're an avid purchaser, but they just forget things. So I wanted to ask you really quick. These are very lender related questions. First question that I have for you is, how do you get pre-approved?
That's a great question. So a lot of people overthink this part of the process. It's really just starts with a conversation. And when they talk with a lender and we go over the application with them themselves, right? And there's four major components in it: cash, credit, income, and the property. So cash, where's the money coming from? That's why we ask in the application, checking savings, right? Where's that money going to come from? Even if it's a gift, even if they don't have it, at least we know how much they're going to need so they can prepare for savings. Yeah. Credit, same thing. And it's not just a matter of the credit scores. It's also a matter of what's showing on the report. So they may have some random collection from a parking ticket or something erroneous, like they authorized signer for a card that doesn't belong to them, a relative. Take those things off, right? So it helps them qualify. So then reviewing credit with them together for accuracy. And then we talk about the property type as well. Condos are different, as you know. It has HOA dues versus a single family where that doesn't have that extra expense. So it's one thing we don't have to qualify. Or if they're looking in a particular neighborhood or area, let's say like they're in the outskirts, now we're talking about insurance. Fire insurance coverage is expensive. We want to factor that in for the area.
Right.
That's all going to affect their budget.
Okay.
And then income. It's not just about how much you make, but how you make it. Mm-hmm. The key thing is what's likely to continue. So if they're hourly or their salary's fixed, we know that. If it's commission based, we're going to want to see an average over time.
Okay.
Things like that. So that's really in the application why it's so important to take and going over those details.
Got it. And some people don't do this, but I always tell clients, look at a realtor as well as an actual lender as a financial advisor. Make sure that you go to them prior, just even thinking about just thoughts about actually purchasing or making a move.
Yeah, I think that starts before the application itself, is get with a trusted advisor, which would be the realtor. So that way they can walk them through the process. Because just like you said, in order for them to get to the plate of taking the application, many times they don't know that's where to begin. And usually the realtor has really good resources for them to feel comfortable. The other thing is through the realtor is the communication gap. So many people don't understand the differences of working with different lenders. So when you're having let's say a large institution, a credit union as an example, mm-hmm. Your job as an agent is 24 hours a day, right. 7 days a week. So if you're going to be submitting offers after 5 o'clock and it's a multi-unit property or has HOA or any sort of question you may have, you may get stuck not being able to write that offer at that moment because of the inability to have good communication, especially on weekends. People are shopping for houses on Saturdays and on Sundays. And as you know, there's no inventory on the market. So you may not have the luxury to wait 24 hours to get the answers to get your offer submit.
100%. This is actually something that happens all the time, and I get asked questions on this. When do you actually submit offers? And normally on Sunday night, between the hours of like 7 to 11 p.m., we're submitting offers mm-hmm. so that the listing agents from those listings actually go over the offers with their clients the next morning, potentially up to noon or 2, and then make a decision that evening on Monday. So it is important that we have everything ready, that we're able to contact potentially the lender to be able to make the moves. And that's one thing that is important compared to someone that is a mortgage banker mm-hmm. versus someone that works at a credit union or at a bank. Because mm-hmm. in my experience, normally mortgage bankers like yourself, you guys are available all the time. It's your own business. And yeah, you put in your boundaries. That's extremely important as well. But it's much easier for me to text you at 5 p.m. on a Sunday asking you for a pre-approval because of a certain amount than if I want to text someone that works at a credit union or a bank.
Yeah, that's a very, very good point. A very sharp distinction as well. So a lot of people don't know the 3 different types of institutions. So you have one, which is your big box bank. And your big box bank doesn't necessarily offer that very many programs. They're very limited. They're very strict typically on their credit policies and guidelines.
Yeah.
And availability, right? It's very transactional. And a lot of times the lenders that work in those operations, they also do credit cards, car loans, checking. They don't specialize specifically in mortgages. On the opposite end of the spectrum is your brokers. Now, the broker is basically a lender that would find you the loan. They're not themselves putting up the money. They're not doing the underwriting for the file. They're just starting the file and then kind of shopping it around with different lenders. Okay. Now, usually what they'll try to do is get the best deal out there, but you're actually paying that person like a finder's fee. They call it an origination fee. They're originating the loan, right? The downside of that is also not as much control of the transaction. I can walk down the hallway and talk to my underwriter. I can pick up the phone and get answers on specific issues. When you're going through multiple institutions and you don't have those relationships, it can make it difficult, right? In the middle is what I do. It's what's mortgage banking. So I can broker a loan if I need to because maybe my underwriters don't do something in-house. Okay. But the majority of the loans, the traditional VA, conventional, FHA, like 80% of the bread and butter is done internally. We're funding it with our own money. And after it closes, maybe we'll sell it, maybe we service it, but all we do is pure mortgages. So in my world, I have a lot more control. So when you're looking at a property and maybe there is something challenging on the transaction, how is this particular loan type, how are they going to interpret something? For me, it's easier to be able to get a lot of those answers because that's why it's all in-house.
Yes. Okay, great. That's actually a really, really good point and a great distinction summary on it. Another question that I have as a follow-up is when there's money that comes in randomly, whether because you had some sort of insurance claim or there was inheritance that came in, and let's say for the sake of it is $150,000. Can you actually use that money right away there's a word that I always hear about money maturing. Not entirely sure. And now I actually don't know how it works with you guys. Could you explain that a little more?
Yeah. So basically the term is called seasoning. Okay. Now seasoning falls under a couple different categories. So when we're doing a specific type of loan type, it's going to have specific type of guidelines.
The question that we have all the time with our clients is, I'm getting some money from either an insurance claim or a family member of $150,000 to maybe $200,000. Can I use that right away? What do I have to do?
Good question. So basically what it is, it's going to fall under two different categories. So one is going to fall under the guidelines of the loan type. So federal loans, FHA, VA, since they're federal loans, those funds need to be paper trailed because the government's not in the business of doing money laundering, right? So they have specific guidelines. Another side is the banking side. So on the banking side, they're going to do anything what's called a suspicious transaction, right? So not to be confused with the loan. So when you go into the bank and if you deposit cash in there greater than $10,000, you're going to have to write the reason down, right? Now, if you're depositing cash, that's where it kind of gets red flags. So what we'll try to do is we'll allow them to deposit the money as long as we can paper trail it. That's all they really care about. So even if they sold a vehicle, we have to provide a deed of transfer, maybe a Kelley Blue Book sample of what the vehicle was sold for. It's sold for around the price point that the property is valued at, a cashier's check, things like that. But when it's hard cash money, then it has to typically be seasoned in the account for at least 60 days. And the reason we require that 60-day time frame is so the bank is able to do their due diligence on being able to investigate those funds for like money laundering purposes.
Got it. That's extremely important. Thank you for that, Anthony. One other question that I always get from my client is, do you actually need a 720 credit score to be able to qualify?
Not at all. And then this is actually a really good one, and it gets very confusing for a lot of people. So I get both ends of the spectrum. If you have a 780 credit score, some people think your interest rate should be like 1%, right? It doesn't work that way. So think of it like grades. 720 and above is an A.
Okay.
680 to 720, it's a B. 680 to 660, C. Below 660, D. Below 620, F. Right? And so that's one way to look at it. Right?
Yeah.
But it doesn't mean you're not going to get a loan. Because can you graduate with a D?
Yeah.
Yeah. Okay. Right? Okay. So that's one aspect. And then there's other programs that don't even require credit scores.
Okay.
So FHA, VA being two different programs. However, that doesn't mean that you can get a loan when you show financial mismanagement.
Okay.
Different. Because you can have a 680 credit score and have overdrafts on your checking account. That's considered financial mismanagement.
Okay.
Right?
Got it.
So it could be detrimental. On some loan types, the way that they treat the credit score is a lot how car insurances treat car insurance policies. So if you have no tickets, low risk, great. You're going to have a very cheap premium. You're going to have a very low interest rate. But if you have a ticket or two, okay, a couple dings on your credit, higher risk, higher interest rate.
It seems like what the credit does is that if you really think about it, it's kind of an image how you behave financially for a long period of time.
It's based on the level of risk of the person. And that's not for all loan types.
Okay.
And that's where the confusion comes in. So conventional mortgages, those ones that get sent to the traditional institutions, the B of A, the Wells, right? Those are the ones that buy the bonds from that program. Conventional mortgages, Fannie Mae, Freddie Mac loans. Those are based on risk premiums. So credit score of 680, 700, 720, 740, right? Property type, debt to income type. They have all these different grids that adjust the pricing based on risk. Conventional. FHA, however, and VA, it doesn't really matter typically. So above a 660 credit score, you get the same interest rate as somebody with a 800.
Now, can anyone purchase a property with unconventional credit? And when I'm talking about that is potentially a letter from the cell phone company saying that for the last 24 months they paid on time, or for the last 3 years?
Yeah, that's a great question. So again, depending on the loan type. So what we call those is non-traditional credit. And this is a really easy way to actually get credit. So a lot of people don't know nowadays, you're able to go online, like Equifax is a good example, and you can put in there non-traditional credit history.
Okay.
So you send in copies of your bank statements, and maybe you want to have your rent, which is a really good one. So you want your rent, good payment history to show in your credit report. You pay a $75 annual fee. You send them copies of the canceled checks. They'll verify with a property management company. And guess what? Now in your credit report, you're now going to have a new trade line there of on-time payments to XYZ property management company.
Got it.
Typically, those are going to be things recommended for somebody who, a person like myself. I don't have credit cards. I haven't had credit cards in 15 years. I take that back. I actually have 2 credit cards, but they're both prepaid credit cards. And the reason I have them prepaid is because they can never close them on me. I just never use them. And the only reason I have them on my credit is because since I don't use credit, I won't have FICO scores to report.
Right.
I've learned that lesson a few years ago because I have always bought everything cash. Being in the mortgage business, I see what debt does to people. So I just don't do it.
That's so interesting.
Crazy, right?
Yeah.
So I can have millions of dollars in properties, but then I go lease a BMW and I'm there for like 2 hours.
Wow. Do you know what the average amount of credit cards an American has?
I heard it's like 13 or something like that, or 18. It was like a lot.
Yeah, the last I read about it, which was last year, it was 10 credit cards.
Yeah.
10 credit cards was the average. It's insane.
No. And the lines of credit, I want to say I think it is 18, because that's just credit cards.
Right.
Once you stack into it, a couple cars, husband and wife have 2-3 cars. Then you have your kids, a couple payments to student loan debts. And then on average, it's like 18 or something like that.
Wow, it's huge.
Yeah.
Yeah, and banks make a lot of money out of that. So it is. I like your approach. I definitely like your approach. I have a question here that has to do with buying a home, and I get this a lot from different clients, can buying a house give you some sort of tax deduction?
Typically, yes. I'm not a CPA.
Yeah.
So and it also varies state to state, but typically the interest that you're going to have on a mortgage to a specific amount is typically deductible on your income tax, which is one of the biggest benefits. So we call it post-tax and pre-tax. So your pre-tax is your full monthly payment. And the reason I say this is because let's say you're renting a house, and your monthly payment for the house is $3,500 a month because that's what you're renting. And then you want to buy something. And you say, Virgilio, I want to buy something. And you ask, how much do you feel you can pay? And you're like, well, I'm paying $3,500 in rent. I want to try and keep my mortgage at $3,500. In reality, you're doing yourself a disservice, because even though you have $3,500 a month in payment, your post-tax benefit is probably anywhere between $400 to $600 a month. So you theoretically would have to have a mortgage of around $4,200 a month, because after you get your refund from taxes, you're going to end up being at about $3,500 a month, what you were traditionally renting. Okay. A way to work around that. So there's something that a lot of people don't use or don't know about, is what's called an MCC. Okay. So an MCC is a mortgage credit coupon. Okay. The mortgage credit, basically all we're doing is we tell your employer, hey, this person's planning on buying a house. They're going to be estimated paying, $30,000 a year in interest. Please revise their withholdings by this amount. Okay. So that way, instead, you'll be able to receive more money per month in your paycheck to offset that monthly payment. So instead of waiting for the end of the year to file your taxes and get a refund, you can actually take the benefit up front of home ownership. So a lot of people don't know that. And even on the lender side, it even helps us in qualifying sometimes. If we have like income that's really, really tight and they fall within the guidelines, I'm like, hey, maybe we put this into an MCC, get a W-9 to your employer, change your withholdings. You're not going to get the refund at the end of the year, but now you're going to have more take-home money every month to help afford that payment.
Now, can that be applied also to someone that is self-employed and pays his taxes, let's say, quarterly?
Self-employed is a little bit different because you are the withholder. Right. So it's really up to you. So typically for your W-2 person, that's who it's really going to benefit. But from the self-employed person, it goes another step further. We're going to want to sit down also with your CPA to break down, hey, here's something that you're going to have at the end of the year as an additional projected deduction. Okay. Maybe we don't want to write off as much as you do, or maybe you want to roll over some write-offs. Maybe you want to put that extra money that you're saving into a Roth IRA, right? So it just opens up discussions on how you can tax strategize.
Another question that I get all the time once we actually open the transaction and an offer gets accepted is, why is it that an appraisal is important, and what does it actually do?
So the appraisal is really important for about 4 different really reasons. Okay, the first obvious reason is protecting the bank. The bank does not want to lend more than what the property is valued at. So first it's the bank. The second is the buyer. Obviously, the buyer doesn't want to overpay what the property is valued at. But a third one is also your insurance company, because when you do get the appraisal, it breaks up land value to structural value. And you want to make sure you have enough coverage for the structural value. Case in point, let's say you buy a property with a very small lot. Okay. It's a 3,000 square foot lot, but the house is 3,000 square feet. It's the majority of that's a 3-story building. Pacific Beach, a good example. Mm-hmm. You want to make sure your coverage is going to cover the rebuildment cost of that property. And so does the lender too. Mm-hmm. So it also, that appraisal allows them to look at how should we assess the rebuilding of this property in the future so you're protected, right? Mm-hmm. But number 4 also is it doesn't replace an actual home inspection, but it allows you to get some idea of the condition of the property. So things like peeling paint, right? That's one condition. It could be lead-based. The appraiser may call those things out. floors that may have asbestos, right? Or a heating source, things like that. But on top of that, any sort of extra things in the property, solar, a pool, those are different assessed values also, because as a homeowner, I'll give you a good example. A client was looking to purchase a house. One house was $20,000 more than the other, but it had this sick pool, ginormous, nice, beautiful pool. And the guy was like, well, I'm not sure, Anthony. Should I build my pool or should I just buy a house with a pool? I go, bro, building a pool is going to cost you 75 to 100 grand. Buy the house with the pool.
Way more.
Finance it into your house. You're good. You're done. Because if you want to build a pool after the fact, now you're going to have to get a second mortgage. It's going to be 15, 20% interest rate. Who knows what they're going to charge you. And you're going to have to go through all that process, but you're not going to get it in return down the line when you want to sell it.
That's a great point.
Yeah.
Follow-up question on this. Do appraisers treat their properties differently, whether the house or the loan is on a primary home or is going to be considered an investment property?
That's a good question. So what that really is it's a supplemental. So the appraisal is the appraisal based on comparables,
okay,
right? So theoretically, each appraiser should really view the property the same. The market is what it is, and they're looking for a like type. Okay. Now, when you have a variety of properties to compare from, 20, your 5 or 6 that you select may not be the exact same 5 or 6 that I select. Definitely. So that's where the variance comes in. Then, based on, let's say, the amenities and square footage, you may say, oh, well, you know what? I'm talking to contractors, and I think replacement cost is somewhere between $350 a square foot. Me, I can be at $275. So I may add additional square footage on my appraisal a little bit more conservatively, where you may add a little bit more aggressively. It's not going to change the appraisal drastic, but when you're talking, 3% on a $700,000 property, that's $20,000 variance, right? Just that alone, right?
Yes.
So appraisal to appraiser, no real difference. But when you're looking at an investment property, they're going to go one step further and they're going to do what's called a rental survey. Okay. So if you're buying a multi-unit in Spring Valley, then it's 2 bedrooms and it's 1 bath, 650 square feet. They're going to go in places like Rental Meter. They're going to go like on Craigslist, and they're going to look at what kind of comparables of rent they're able to collect to assess what the cash flow is on that property. So it's just a supplemental to an existing appraisal.
Okay, that totally makes sense. A follow up on the question on the lending side. I always get this question from my clients is, so we have 3 credit scores. And which credit score does the actual lender use to give us basically our interest rate?
Got it. Great question, because this is also one that gets confused for a lot of people for different reasons. So the way it works is like this. Let's say you have 2 clients, husband and wife. Husband has 700, 710, 720. The wife has 650, 660, 670. The middle score, so in hers would be the 660. Mm-hmm. His middle score, 710. The way conventional looks at it is they average the 2. They add the middle of hers, middle of his, average the middle. We're going to look at this as a 685 credit score. Okay, that's conventional. FHA would be, 660. Why 660? Because it's the lower of the 2. And people ask me, well, why my score is great? How come we're not going off of my score? Same like car insurance, right? You can have a really clean record on your car insurance. I can have a DUI. But if you and I get car insurance together, are they going to give me your price? Or are they going to give me my price?
They're going to follow the price of the person that has the worst.
The highest risk.
The highest risk. That's what it is.
Right?
The highest risk.
So the highest risk.
Yeah.
So to answer your question, when you're looking at those 3 middle scores, it's the lower of the 2 is what the pricing is based off of. The person that's the most risky participating in the transaction.
And it totally makes sense because it goes back to that financial behavior, whether you're going to pay on time or not.
Yeah.
It makes sense. The other question that I always get from clients is, can I actually buy a house from a family member?
You can. And actually, I do a lot of these. There's arm's length and non-arm's length, right? So when you have an arm's length transaction, arm's length, I can touch you, buying from a family member, sometimes there's certain guidelines that can get added into that. So here's a good example. FHA is a good one. So let's say I'm living in a property from you, or actually, I'm living in a property from you that I'm renting, okay? And you're my family member. I have to show that I'm paying my rent on time to get maximum financeability.
Got it. Okay.
Okay. But let's say I'm renting from you and I'm paying you cash. Okay. FHA will maybe limit me to 85% because I'm not able to document my monthly payment with you as arm's length. So sometimes it could be a little stipulation in there. But let's say you have that property and it's currently a rental and I have no relationship with that property currently. I'm not living in it. Yeah, you can sell it to me directly. I can buy it from you. And we can even go one step further because many times when you're buying it from a relative, you're going to get it for a deal sometimes.
More than likely, yes.
Right? So let's say you're selling a property for, it's worth $750 and you're like, Mijo, you know what? I'll sell it to you for $600. I can actually take the difference, the $150,000 difference, and treat it as what's called a gift of equity. That $150,000 can now be used on paper, the equivalent of a down payment. So I can take the $750 value, use the $150,000 as a down. Now I got more than 20% down. Make sense?
Yeah.
And I can now, use that as part of my transaction.
Because then also at the same time, on the other hand, the person that's not going to have a private mortgage insurance, as an example.
You can avoid private mortgage insurance too.
So that's actually really good. I have no idea that you could do that.
Yeah, I do it all the time.
That's pretty amazing. Well, I'll definitely keep that in mind when I'm going to go ahead and sell some houses. Some of my
I did it for my brother-in-law. I want to say probably about 15 years ago, something like that. I bought a foreclosure. I paid $425 in Temecula. Mm-hmm. My wife really wanted him, to live close by, and so I was like, "Hey, you want your family to live like around the corner? I just got this house," and she's like, "What?" I'm like, "Yeah, it's worth $600, and I got $425 for it." And she's like, "Really?" I'm like, "Yeah." So I closed on my deal, bought it from Fannie Mae. Called my brother-in-law, say, "Hey, bro, I got a house I'm gonna give you, and if you don't want it, I'm gonna take the proceeds and I'm gonna go buy a boat." I literally told him that. Okay, I'm gonna go buy a boat. So anyhow, when we did his transaction, I gave him $180,000 in gift of equity, and because it appraised for the $600, I was able to give a seller credit towards the closing costs. So he literally walked into that property, no cash out of pocket, 20% down, done. Here's the keys, my new neighbor.
Did you actually get any money from that transaction yourself?
No, I got tax deductions. You know what I mean? From the cost of the acquisition cost of the sale, right. I was able to write it off. But there's a thing, it's called lifetime gift tax. So I believe at the time, it's probably higher now, it was up to $3 million that you can give away. Mm-hmm. That's non-taxable.
Is that for the lifespan?
For my lifespan.
Your entire lifespan?
Mm-hmm. Okay. For my lifespan. So you're able to do, it comes out of the lifetime gift tax. So you can give a gift in that manner without penalty of tax.
And you did that for this transaction?
Mm-hmm.
Wow, that's amazing. That's pretty
He ended up foreclosing, but...
Oh, no. That's no good. No good at all.
I know. I was pissed. Actually, no, he didn't end up foreclosing. I think they ended up short selling because at the time, this was like when the beginning of the market cycle before it started to really shift back then. Mm-hmm. It's like 2009-ish. And so, I got it from foreclosure. There wasn't a lot of foreclosures. The market was still kind of hot at that time. I just got lucky when I got it. But as the market continued, it dropped below the $425 I sold it to him for. So it went to like $350s or something crazy. And just the situation, the way it was, out of my control. So eventually, economy slowed down and But my intentions were great. I should have probably flipped it and bought a boat, but it was nice having them as my neighbor.
That was really, really amazing of you. You always have that insight. And for that, you're a better person.
Thank you.
I always get this other question all the time about potentially buying stuff while in the transaction of buying a home.
Uh-huh.
And, it could be stuff like, we're getting inches. It's about time for us to move. So we want to go ahead and buy furniture. Some people, for some reason, want to go ahead and buy a car.
Yeah. They want everything new we just got married. We want to get the new Tesla. We want to get new furniture. Yeah.
And how does that work? As a realtor, I've been around for a long time. It's 7 years. I feel like it's 14. But I always tell my clients, make sure if you're going to buy something big that you actually talk to your lender. But I never really thought about it that deep, and I wanted to get your idea and where actually that comes from.
So really what the lender's looking at is a snapshot in time. So we want to see what debts does this person have as a snapshot in time. And one thing a lot of clients don't know is that we're monitoring the credit. And the reason we monitor the credit is for something called shotgunning. Shotgunning is a situation where, let's say, somebody wants to buy 3 houses at the same time. Okay. And so by monitoring their credit, we'll see if they pick up new debt in the process. The credit reporting agencies will actually send us a notification even when they run their credit. So if they had credit ran by multiple companies, they actually had to sign a form stating, I was just applying and I've received no new debt. Okay.
Got it.
But the premise of it is to prevent an individual who has no mortgages on their name and wants to all of a sudden buy 3 houses owner occupied, right?
Okay.
And they're not telling all 3 lenders. Okay. So that's what it's really meant for.
Is it safe to assume that there was a time in the past where people tried to purchase 2 or 3 houses at the same time, close on the property the same day, and probably this rule was created?
Yeah, it's called shotgunning. So there's another system, another layer that typically lenders will talk about, but it's called MERS. MERS stands for Mortgage Electronic Registration System. MERS is where all the mortgages get scanned and recorded. It's like the DMV for mortgages.
Got it.
So right at funding, the funder will jump into the MERS system and see, has anything been logged in as a new mortgage for this person? Sometimes it gets flagged. You may have the same name. Let's say your dad has the same name as you.
Which is the case.
Which happens. Right. It happens. And it'll pop up on MERS and they'll say, hey, is this the same and the same? And they may red flag it at the very last minute. And so, but it's not typical that you're going to see a loan close, within 24, 48 hours of each other.
And when that happens though, and it is flagged, what do you guys do?
We'll pause. So flag on the field.
Okay.
Timeout.
Would you go back to the client and say, we verified there's something going on here with another name?
All the time.
Is this you or is it someone else? And if no,
it happens a lot, especially during inheritances.
Okay.
So like you're going to inherit a property. Let's say they had land free and clear, right? And now you're going to be picking up another one. You just got this money. So now, hey, I'm going to buy this house, Anthony. My dad just passed away. I got $1 million to spend. And also he owned some land in Montana, right? All of a sudden that land gets recorded. It pops up as public record. It was non-disclosed. Now here's why it's important. When you own the land, even though there may be no loan against it, guess what? You owe property taxes on that. Right. That's now a legal obligation. Therefore, we need to now add this land into your schedule of real estate owned and hit you with that new monthly payment obligation for the land tax. So little things like that.
That's important to note. And one other thing that is always extremely important with that when the clients are in this process is a subject called supplemental tax bills.
Yes.
And I always get a call from my clients, normally anywhere between a month to 3 months after they become homeowners. And they normally also send a picture and they say, hey, what is this? Oh my God. Like, where are we? Do we have to pay for it? Although I always talk to them about it during the transaction, they seem to forget. My understanding is that a lot of lenders, and I would love for you to speak about supplemental tax bill and what it is, but a lot of lenders actually include the supplemental tax bill amount in the impound account or in the actual, I would say, the closing costs. So if you want to clear that out for me.
Sort of. So what happens is from the lender standpoint, we want to qualify based on what the future taxable amount's going to be. That's what we're qualifying from. But at closing, we cannot legally withhold more than what's pre-existing on taxes.
Okay.
There's a time delay from the time you close to the time the tax assessor revalues the property. Okay. So if you close and you buy a property for $700,000 and the previous owner bought it for $300,000, that $400,000 variance is what you're going to fall short on. So at closing, we're going to be collecting monthly payment in the future for that $700 or $7,000 tax bill, right?
Yes.
We're collecting for that for the next bill. However, at closing, you only pay taxes on the $300,000 tax base of the previous owner. So the county takes anywhere between 3 to 9 months to recapture that shortfall of the assessed value. And then you're going to get a notice in the mail saying, hey, Virgilio, guess what? You have $4,000 on your supplemental.
Right.
We will take that in 2 installments of $2,000 and this month, and 6 months later, $2,000 more.
Right.
But as far as your monthly payment, you're already making the payment for the future tax bill once it gets reassessed.
Now, is that actually done by every single lender? Because I actually heard stories that a lot of lenders don't do it like that. And when I talk to some of my clients and they say, oh, I go in ahead and talk to the servicer, they actually don't have the money in the account to pay the supplemental tax bill.
So, yeah, the lender, we don't collect for it. And it's not really the lender. It's the escrow company. So the escrow company is going to follow what the title company says. The escrow company and title cannot legally charge more than what's currently assessed on tax bill, on the tax bill.
Yeah.
They can't. Now, where the confusion starts to come in from is how it's handled. Sometimes the bill will come from the tax assessor and the lender didn't have notification. Sometimes the lender got the bill ahead of time and the bill will come from the servicer. And they'll say, hey, Virgilio, we just received this bill for $4,000. How do you want to handle it? You have 60 days and 30 days to respond. If you don't respond, we're going to take the $4,000 divided by 12 and include it in your monthly mortgage payment. We're going to reassess our withholdings on you to make sure that this bill is paid.
That makes sense. What I did on mine when I got my tax bill when I bought my first home, I actually called the servicer. I asked how much money there was in the account, and it was actually a pretty good amount. My bill was about $3,200 or so, and I asked them to go ahead and pay it. Now, when they recalculated the account, I got a letter saying that I was short about $900. They were going to increase my bill a certain amount every month.
$100 a month, whatever it is.
And it worked out really well, and I didn't really feel it or anything.
Mm-hmm. Yeah. And again, this is only when you're doing that, and it's worked through the servicer. It doesn't necessarily always work out that way.
Great, that's really good information. One thing that we always get, and you probably get this every single day, maybe on like 2 or 3 different calls with someone that is a new buyer, and is my understanding is that I have to put down 20% to be able to buy a house. And I get this call all the time. And even at 7 years now, I know how long have you been in the industry for?
Almost 2 decades.
Almost 2 decades, right? Which is great. It just says a lot about you, your profession, and how you basically talk to clients and what you do. You do it so well. But one, is it true? Second, why is it that although with all the marketing that exists and that you always see on TV, Instagram, TikTok, you name it, saying that it's not true, people still have that mindset or that idea in their head?
You know, it's because I think a lot of times there's certain generalities in the real estate industry. And this is how I like to use things a lot of times in analogies. Just because you had a baby doesn't make you a pediatrician, right?
Right.
Just because one person bought a home doesn't make them a lender or a realtor, okay? So when they bought their home back in 1980, and they bought it at the time where maybe PMI might have been a lot more expensive. PMI today, mortgage insurance today is a lot cheaper today because there's a lot better algorithms they can look at for default. So higher credit scores, mortgage insurance could be extremely cheap. Okay. So, but you're having this conversation at dinner with your uncle. Oh, no, I mean, you got to buy a house. You got to put 20% down because the mortgage insurance is a waste of money and blah, blah, blah. My dad told me something different, and I remember this to this day. He says, Mijo, you know what? You cannot save as fast as properties appreciate.
Whole different perspective.
Whole different perspective. He's like, if you can get that thing now, get it now. So in the meanwhile, thinking like my cousin, I'm going to try and save 20% down to save myself $150 a month in payment. I buy my fourplex for $325. He buys his condo for $225. Why? Because he waited 5 years longer than I did, because he's trying to save his 20% because he's listening to his dad, who he's treating like a pediatrician, right? And my mom, luckily, was a mortgage banker for Bank of America for like 35 years. So two different perspectives. Luckily, I got good advice.
And unfortunately, this in this particular example, that person lost on average here anywhere between 4 to 8% per year.
We don't want to talk about that.
A lot of money.
Because from 2000 to 2005, property went up a lot, bro.
A lot.
They went up a lot.
Especially in the last 2 years during COVID. I think it was 20% and 22% for
Bro,
those years.
42. At that time, I sold that property off for $1.1 million.
Oh my God.
So
wow.
When he paid $225 and I sold my fourplex for 1.1 and he could have bought,
That's insane.
That was my dad was right. There's no way in hell I would have been able to save $700,000, as much as my property would appreciate. Like and you think about it, right? Because if a property goes up 10% on $600,000, that's $60,000. Are you going to save 60 grand realistically in a year?
Not very many people can do that. That's the honest truth. And honesty, when I'm thinking about it, like you want to look at buying a house and paying your monthly mortgage kind of as a savings account.
Yeah. And that's another thing a lot of people don't do. They're not looking at the actual overall benefits. So when you're making that monthly payment, here's something else that we talked about. I know we talked about taxes, right? So post-tax, pre-tax. But let's just say apples to apples. I was renting for $3,500 and now I'm paying a mortgage for $3,500. I'm actually not even really paying $3,500. I'm really paying like $3,300, $3,200 because a portion of that monthly payment is going to my principal.
Okay.
That principal is in essence my savings account, because as I keep making those payments in 1 year, 2 years, and 5 years, even if values don't change at all, I now have $25,000, $30,000, $40,000 in principal pay down.
Right.
That's mine. That's my money.
Mm-hmm.
So, when people go into these things, you cannot use what your pre-existing rent is to housing because of the benefit of homeownership.
No, 100%. I had the ability to buy a home in 2021, got it for $500,000. It needed to be a little bit remodeled. And I was looking at the prices this week and I could sell it for $750 at least. And I owe about $440 already on it. So, that's really good chunk of money that I have in there.
Make $250. So this is another thing. People don't know this. So there's a tax rule for homeowners. If you live in a property for 2 years out of the last 5 years, whether it was the first 2 years or the last 2 years of the 5-year window, for a husband and wife, you can net up to $500,000 tax-free.
And this is federal and state?
Yeah.
Okay.
If it's an individual, $250,000 tax-free, as long as you've lived in that house for 2 out of the last 5 years.
Now, what happens if you have this house?
My wife hates that, by the way. Because when we were first married, bro, I moved every 2 years.
Actually, I was just going to say, I know someone, a realtor,
Yeah.
that does that still.
Yeah.
And she's been in the industry for like 25 years.
Yeah, it sucked. September, because we got married in September 30th. So September 30th was when we had my first place. And then 2 years after that, we moved to Temecula. And then 2 years after that, I bought another house in Temecula. And then 2 years after that, I bought a condo in PB. And then 2 years after that, we ended up moving to UTC. So it's like every 2 years, literally. And then as time progressed in that 5-year window, I rented it out, let the property continue to appreciate. Bam.
But
Cash
I mean,
out.
in that period of time, you made at least what, $500K
Well, extra
or
3
less.
years of
At
appreciation.
least.
Yeah. So 3 years of appreciation, even
amazing.
a 5% clip on 500,000 is 25 grand. I mean, that's on 5%, and it went up a lot more than 5%.
It's amazing. I know it's already 12. So
Yeah.
we want to probably cut it.
Okay. I'm cool.
Cool.